Cue the photos of traders looking concerned. It's been that kind of a day. Investor Beat starts now. Thanks for watching. I'm Alison Southwick. We're seeing a lot of red today. The Dow is down, the S&P 500 is down, the NASDAQ Composite is down. And with earnings season kicking off tomorrow, yes, Alcoa is still the starter's pistol. We'll see if the first few companies reporting can reverse the pessimism. Joining me in studio is Jason Moser and Taylor Muckerman. Our top story is we're going to stay on the NASDAQ Composite because it rocketed up 41% last year, led by companies like Tesla and Facebook. But lately, so-called momentum tech stocks have been taking a hit. Tesla, for example, fell nearly 6% on Friday, and it's leading some to wonder if these shares flew a little too close to the sun. So, Jason, what's being blamed for this slump? I mean, why now?
Well, I mean, I think you said a key word there at the beginning with momentum. And I think a lot of these stocks that we're seeing selling off now were all big momentum stocks. And this sell-off is indiscriminate, right? I mean, it's everybody from Amazon and Netflix to Tesla and everywhere in between. And so, we have earnings season coming up. So there's probably a little bit of selling, going into earnings season because there was some sort of cautionary guiding down as we're coming into earnings season. And I think it's you're going to have a really hard time arguing that really any of these companies were cheap or even rationally valued at any point, really. Phenomenal companies they are, but price still matters in the end. And so, I mean, the sell-off actually, I think investors should be embracing this because there are a lot of quality names that are coming back to the pack. And as long as we can maintain our composure, keep a watch list, and look at some of these quality names, there's probably going to be a couple of good buying opportunities here.
So Jason sees some buying opportunities, or at least maybe not yet, but maybe in a little bit here. How about you? Do you see this as a buy opportunity, or is it a wait and see kind of thing?
Yeah, I don't have much tech in my portfolio, so to see the NASDAQ climb, it's up around twice the PE of the S&P 500. So pulling back a little bit, I'm looking at a Qualcomm and Corning. Both companies trading below that NASDAQ benchmark of around 30 times earnings. Qualcomm is the leader in LTE 4G chip making, so I'm really liking the future of that. And then Corning, Gorilla Glass, they're using other applications for that's broadening their diversity away from Apple and the other cell phone makers. So I like both of those companies trading nicely compared to most tech and great names.
All right, so we have been saying earnings season is pretty much upon us here. Are there any tech companies that you're going to be keeping a close eye on, maybe as a bellwether, or maybe just because you're interested in buying them?
Well, I mean, maybe not as a bellwether. I mean, I think, I always look to Apple just to kind of get a gauge on how that's shaking out with iPhones, what they may be bringing to the table next. But, Apple and Google, I think, are great companies to pay attention to always. But look at really social media. I think that's a long-term trend that's really just getting underway. So you look at Facebook, LinkedIn, and Twitter all together. Those are three companies that I think have room in virtually anyone's portfolio if you're looking for a 5 to 10 year holding. But again, price does matter. I think the one thing you want to avoid is falling into the trap of all the hype around all of these IPOs recently. And these IPOs, I think, are another good sign that the market is a bit frothy, because when you start seeing all these companies wanting to go public and they're kind of rushing to get it done very quickly, I think that what they're seeing out there is almost free money. They want to get it while the getting's good. And so that's another good indicator that the market's a little bit expensive. But again, as they start pulling back, look for the quality names, your Amazons, Netflixes, Pricelines, things like that. You'll be okay.
Man, I think we just mentioned just about every consumer tech company out there. All right, let's take a look at some of the day's movers and shakers. Word leaked today that Twitter has acquired Cover, an Android app that adjusts what's on your phone's home screen based on where you are. So is this just like a little hedge against iOS? I mean, I have no idea what Twitter is going to do with this technology.
I don't know that it's a hedge against iOS. I mean, I think Twitter recognizes the fact that Android is the most popular mobile platform out there right now. So they are, taking advantage of that. And I expect them, fully to take advantage of the iOS as well. But I think this is actually a neat little application here because basically, the longer you have your mobile phone, the more apps you collect. And it becomes sort of difficult to figure out where's what app I need when I need it. And so essentially what this acquisition does, what this app does, is it puts those apps where they need to be when you want them to be. So when you wake up in the morning, you may have apps that are relevant where you're having breakfast, you want to read your news. When you're at work, it'll be apps that are relevant to your work life. And when you get home, it's going to be apps that are relevant to what you do at night, whether you're Netflixing or whatever it may be. So I actually kind of like the way this organizes things around your Android ecosystem. And I think that a lot of people have been asking the question, how is Twitter going to make money beyond advertising? Because it's nice to see companies with this kind of reach expand beyond just the advertising model. So I think this is at least one effort to do that. I'm not exactly certain how they're going to monetize it, but it's a small little bolt-on acquisition. I bet they'll make something good of it.
All right. Yahoo will start offering original online video programming like Netflix, Amazon, and Hulu. This is according to the Wall Street Journal, who quotes one person in the know saying they want to blow it out big time, which I think that person's probably regretting that that's the quote.
Most likely.
Unless he's some dude from a frat. That's what he got. So what strikes me, though, is that Netflix, Amazon, Hulu, they all have a subscription model. Yahoo, I mean, does this tell us something about Yahoo's future revenue, or are they going to do something different?
They could just be trying to fish in the pond a little bit, maybe a little testing here. They've been very public about moving more towards video as a business, maybe not television series, but they've hired some TV personalities like Katie Couric to come on board. And so they're looking at up to 4 different series right now, 10 episodes, spending about $700 to $1 million per episode. So it's not a huge budget, especially when you look at their 2013 revenue of about $4.7 billion. So they're getting into it, maybe testing the waters a little bit, and it could be something that they play off further down the line.
God, $1 million an episode. I had no idea TV was so expensive. All right. Procter & Gamble raised its quarterly dividend by 7%. The company has raised its dividend for 58 straight years. So Jason, this is a great dividend story, but P&G has been underperforming the market. What do you think about the company?
Well, I mean, I like the fact that when you go into the grocery store, there are a lot of things in there that fall under that Procter & Gamble umbrella. But I think you keyed in on something there. Even with the dividend raise, I mean, investors can count on that. But you look at the last 5 years, and Procter & Gamble stock has woefully underperformed the market. I mean, that's to be expected with the recent market conditions we've had. I mean, last year was phenomenal. But Procter & Gamble is a $200 billion plus market cap company there. So there's not a lot of growth, I think, left for this company. So the argument to invest in it is, are you in a stage of your life where you're looking to protect your wealth more than you're looking to grow your wealth? If you're looking to protect your wealth, then P&G is probably a good pick because it's going to be a 3% or better yield, and they're going to continue to raise that yield over time. And interest rates, even when they start going up, are still going to be really low for a long time to come. So I could think of better places to put your money than Procter & Gamble, but again, if you're in that stage of life trying to protect your wealth, it's not a bad look.
Shares of SunEdison took a hit today after news broke that the company is canceling its solar project in India. So Taylor, it's time to play a little Goldilocks.
All right.
Was the market's reaction too hot, too cold, or just right?
I think it's safe to say it's been out of the microwave for a few minutes. You're looking at this company not turning a profit over the last couple of years based on goodwill impairment and asset write-downs. And that's probably what they're looking at here, to the tune of maybe $300,000 to $350,000, as that was the deposit they had to put down on this project. You look at other countries like the US, China, and Germany really thriving, but India's kind of put in place local sourcing for their panels. So that's really hurt some of these new projects, this one in particular. First Solar has been a big supplier of panels in India, so they have allowed some outside competition, but the higher price that you're seeing from these Indian manufacturers has pushed the likes of SunEdison out from at least one project.
All right, that's going to do it for today. Let's look ahead. What is one stock on your radar?
Well, earnings season's around the corner, right?
Gonna get busy.
Yeah, so it's going to kind of slowly into next week. We'll see it build up. But on Wednesday of this week, Bed Bath & Beyond is going to announce earnings. I have been somewhat bearish on this company for a while. I mean, I've kept a red thumb on it in caps because I just don't really see what differentiates it from any other sort of brick and mortar retail out there. It's kind of a mess when you go in those stores, just not really that pleasant of an experience. So you're seeing more competition from things like Amazon, but even beyond Amazon, I think a lot of people may be dismissing Wayfair.com, which is still a private company, but Wayfair.com is bringing in about $1 billion in sales now, and they have companies like Bed Bath & Beyond square in their site. So I'm not expecting a whole heck of a lot from Bed Bath & Beyond, and I'm still going to keep a thumbs down on it in caps, but we'll see the earnings on Wednesday.
All right, how about you, Taylor?
I'm looking at General Motors. They're coming back at the recalls, 2.6 million recalls. People can take them into the dealership now today, starting today, to get those things fixed. So I'm looking to see how many people actually do bring those in. It's not going to be an easy course for GM because now there's a federal investigation saying that they knew about this in 2004, putting lives at risk. So this is going to play out all year long, possibly into next year, and maybe we'll hear something about it in their first earnings call.
All right, for Jason Moser and Taylor Muckerman, I'm Alison Southwick. Thanks for watching.